Something seems off with India's growth story. Since mid-2024, you could sense that things were somewhat unraveling. Even though the GDP data seemed great, growth indicators were starting to show troubling signs. Consumer goods companies were starting to whisper that demand is faltering. You know, it's like that carton of milk that has been in and out of the fridge for quite some time, and now you think you can smell something funny, but you're not quite sure. But then, as we move to the end of the year, the milk had definitely gone bad. FMCG companies were now openly and frenetically sounding the alarm, complaining that urban consumption is slowing, the middle class is no longer able to afford their products. And in fact, Nestle India's head went on to the extent of saying that India's middle class is shrinking. So, were they all exaggerating? Well, as if to confirm their worst fears, GDP growth in the second quarter of FY25, so July to September, went into a tailspin to 5.4% when everyone, including the RBI, were expecting it to be in the 6.5 to 7% range. And I don't know how to convey to you exactly how shocking this number was for economists. This is the equivalent of, say, one of the toppers in your class suddenly turning up with just pass marks in an exam. Consumption, investments, exports, industry all slowed. Even services that did better than the other sectors slowed from the previous quarter. So what on earth is going wrong? Hello and welcome to The Bond Economist, your one-stop destination for professional advice on the economy. My name is Auradeep Nandi, and today we try to make sense of what's amiss with India's growth story. Why is there suddenly a slowdown? Is this a temporary phase? And what should the government and the RBI do about this? As always, if you like this kind of content, please consider supporting the channel either by hovering your phone over the QR code or by hitting the super thanks button below. First things first, there are a lot of people out there, including policymakers, who still think that we shouldn't get too worried about this GDP growth crash. It's a temporary one-off thing. So what's their argument? One, we had exceptionally good monsoons this year that went on quite a bit into August and September. Now, while this might have been good news for our farmers, the months when these excess rains happen typically is bad for industries like mining, power, construction that need dry weather. Secondly, there was Shraddh in September, so most Hindus generally avoid making big ticket purchases in this time. And three, the government has been struggling to spend, particularly on its infrastructure projects. As we had general elections in the middle of 2024, the Model Code of Conduct prevented departments from spending on major projects until the new government was inducted in and the final budget for the year was presented in July. So most departments had a late start to the year, and the data now shows that they are way behind in meeting their annual targets. And so people, and by people, this includes the RBI, have been saying that please chill. Monsoons are over now. Shraddh is over. The government will eventually start spending. And then October to December is Diwali plus wedding season plus year end. People will again start spending and the economy will bounce back. It is a compelling argument. And frankly, if you buy this, then the rest of this video isn't really meant for you. But if you are starting to wonder if this optimism is sounding just too good to be true, that there's more to India's growth slowdown than just mistimed monsoons or Shraddh or bureaucrats struggling to move their files, you're at the right place. And at the heart of this mystery is the Indian consumer. After the pandemic, there was a boom in spending, and not just any spending. People were going crazy on expensive stuff, making fancy holiday plans, taking staycations, the whole you only live once syndrome, or I need to go where that travel blogger went syndrome, or I need to look good on Instagram syndrome. Take your pick. And who were doing the spending? The rich, the upper middle class, and also people who couldn't afford this lifestyle but wanted it badly. And this spending craze led to three important changes in the Indian economy. One, the urgent need to make easy money. People started pouring money into stock markets, taking big and risky bets with futures and options trading. Film stars and cricketers have been trying to convince you to spend your time and cash on gaming apps, which call themselves fantasy sports but are in fact turbocharged online gambling avenues. Back in the 90s when I was a kid, we would read in newspapers how the police would crack down on cricket betting rings. Turns out now there are apps and websites that openly allow you to bet on the outcome of a match or an over. There is an online betting colosseum being built around you, and while you may think that you are in the audience, you're actually among the gladiators there, where companies are encouraging you to fight until you're broke. Second, there has been a premiumization of the Indian consumer. Companies are quickly realizing that the poor and the middle class are unable to generate demand. The rich and the upper middle class can. And so the focus has been shifting there. Cars and two-wheeler sales are struggling at entry-level models, but are thriving for SUVs and top-end and luxury models. Much of the real estate sales are also happening for luxury high-end apartments while affordable housing is trailing. Same holds for TVs, smartphones. In fact, even for regular household items, FMCG companies are realizing that the value is in premium products. For instance, companies are surprised at how much demand there is for fabric softeners and washing pods for dishwashers, because turns out that even washing hasn't been spared of premiumization. So one, we have an epidemic-like boom in speculation, and two, we have a rapid premiumization of the Indian consumer. And then three, banks have been seeing all this blood in the water and have been circling like sharks to also have a bite of the action. Banks and other financial institutions started to realize that if consumers wanted to spend and they wanted to make risky investments, well then let's give them the money to do just that. So retail credit in India surged. The Indian consumer was bombarded with credit cards, personal loans, microfinance loans, zero-cost EMIs, fintech credit. And as banks, financial companies, fintechs were all jostling against each other to capture market share, obviously they were no longer picky on who they were lending money to. So inevitably, people who were subprime or had a low chance of repaying the loans were being force-fed loans by this ecosystem and being charged sky-high interest rates. Classic case, the microfinance industry. So microfinance companies lend to the poorest of the poor, those who lack collateral and credit history to apply for loans in banks, and in exchange of bringing finance to them, the companies charge a much higher interest rate. Now, microfinance companies were doing this thing called netting off, which means that someone has an existing loan that they're struggling to pay back, and so the company says, don't worry, take another loan from me and use this to net off your existing loan. Indians were getting drunk on credit. At one point, over half of the people taking on a personal loan already had 4 outstanding loans. No wonder growth was strong. But now that dream run seems to be coming to an end. One, because the RBI has come in and said the party's over. Banks typically lend to non-bank financial companies who in turn lend that money to consumers. RBI has now made it more expensive for banks to do this kind of lending. It has additionally rained down regulatory hellfire on these finance companies and fintech firms that have been using loopholes, ignoring compliance, and giving out really risky loans. If you've been paying attention, there's been a regular drumbeat of some or the other NBFC getting shut down or being wrapped on the knuckles by the RBI, be it Paytm Bank or Bajaj Finance or JM Financial, Navi Finserv. Life is no longer easy for shadow banks. In fact, we've covered this issue in detail on the Bond Economist before. I'll leave a link in the description. So households are no longer getting those credit cards and personal loans as easily as they were getting a year or two back. And so retail credit growth has come down sharply. And people are starting to default on their loans. The percentage of accounts who have yet to pay back their loans even 3 months after the due date is actually going up for personal loans and credit card loans. So people aren't getting easy credit. They are unable to pay back their loans. And so naturally, they're scaling down their spending. Also, that pent-up demand that was there after the pandemic is showing signs of wearing off now. Add to this the fact that incomes and jobs aren't growing. In fact, the salary budget of companies has seen a sharp fall in growth. As we've highlighted in the past on this channel, at an all-India level, the share of agricultural jobs are rising within the workforce, but the share of manufacturing or services that typically generate higher quality, higher paying jobs is either stagnating or lower than pre-pandemic levels when we consider the share of these jobs as a part of the workforce. All of this makes the average consumer more vulnerable to inflation, more vulnerable to higher taxes. Companies in turn are seeing this depressed demand and saying that, you know what, we are okay not investing in this environment. Why invest in extra factories when customers are struggling to afford things? And this in turn impacts GDP growth, which brings us to the role of the government and the RBI in all of this. So the central government has been sharply increasing its infrastructure spending, almost doubling it from pre-pandemic levels, but has simultaneously been reducing fiscal deficit, which is the difference between what the government spends versus what it gets. So how do you spend more on roads, railways, ports, etc., while bringing down fiscal deficit from over 9% of GDP during the pandemic to less than 5% of GDP this year? Well, you do two things. One, you cut down on regular public spending, also known as revenue expenditure, which is what the government spends on subsidies, wages, interest income, handouts, public programs, things that go directly to the hands of people. And two, you have to rely more on taxes. So, as of the latest data, which at the time of filming this video was up till October, corporate tax growth this year has only been around 1.2%. GST collections are instead up by 12% compared to last year. Income taxes are up by 20%. Recently, there's been a lot of furor around these GST proposals, a new slab of 35% tax for tobacco and fizzy drinks, increasing GST from 12% to 18% on ready-made garments above 1500 rupees, 28% for what the government defines as luxury. So garments, handbags, sunglasses over 10,000 rupees, pens over 5,000 rupees, luxury spa and salons, and even cufflinks beyond a certain price are to be taxed at 28%. Meanwhile, they are talking of tax concessions for products used by the poor and the lower middle class. Rationale seems fine, right? Let's support the poor and tax the rich. But here's the problem. It is the rich and the upper middle class that are driving the economy currently. You are assuming that the person who is spending on a lavish wedding dress or buying a Ray-Ban sunglasses or a nice handbag will be okay being taxed at nearly 30% on anything that they touch. But remember, many of these people actually consider themselves middle class, even though the government might be treating them as rich. And if you keep taxing the only segments that are consuming, well then one day the golden goose will stop laying the golden eggs. And the rest of the economy that depends on their spending will get hit. See, behind every 15,000, 20,000, 1 lakh rupee worth wedding dress are the livelihoods of thousands of weavers, spinners, traders, shopkeepers who rely on that sale for their living. So you may tell all these people, look, I'm giving you relief on the GST for the 500 rupees or 1,000 rupees shirt that you've bought. But that will be outweighed by the loss of livelihood if the premium segment customers start to slow down their spending. The RBI also has a weird policy calculus going on. Typically, when you see signs of growth slowing as a central bank, you should start reducing interest rates before things get really bad. Because the effect of an interest rate cut today will transmit to the economy after around 6 to 9 months. But the RBI is refusing to budge, saying that, hey, look at high inflation, I can't cut. But the index on which they rely on, the consumer price index, is high only because of a few random food items like, say, vegetables or edible oils, things that are outside the RBI's control. Meanwhile, core inflation, which is the inflation pertaining to regular goods and services, has come down sharply over the last year. And there is little sign that higher food prices are spilling onto higher core inflation. Now, every time I say this, there's always some people in the comment section who say, hey, how dare you? Look how much I am paying on health or education or living expenses. Agreed. But the government compiles the consumer price index on an all-India basis. And this is what the RBI is mandated to follow. So the point is this. The RBI is currently keeping interest rates high to slow down growth to control inflation. But growth is already slowing down on its own. So what's the point in keeping interest rates high? And look, yes, there will be parts of the economy that will do just fine. India's medium-term growth story of a young population, stable macro fundamentals, stable political system, and increasing interest by foreign firms to shift manufacturing to India away from China. The fact that we are one of the world's largest back offices for all kinds of services for global companies in our global capability centers, that story is still intact. But the cycle is slowing. And when the cycle slows, the government and the central bank needs to react. If you instead keep interest rates high, keep taxes high, keep public spending tight at a time when growth is slowing, you risk adding to the slowdown rather than solving it. For more such insights, like, share and subscribe to The Bond Economist.